Here is a math problem most Canadians have never actually worked through. And when they do, it genuinely changes how they think about what safe means with their money. You have $100,000 in a savings account earning 3% per year. Your marginal tax rate on interest income is approximately 31%, completely normal for a Canadian earning $60,000 to $80,000 per year. After tax, your 3% interest becomes approximately 2.07% after-tax return. Now, subtract Canada's long-run average inflation rate of approximately 2% per year. Your real after-tax, after-inflation return is approximately positive 0.07% per year. Not 3%, not 2%, 0.07%. On $100,000, that is $70 per year in real purchasing power gain, less than $2 per week from $100,000. And this is the good news version. The scenario where the savings account rate is 3%, and inflation is running at the BOC's 2% target. In 2022, when Canadian inflation hit 8.1%, and high-interest savings accounts were paying 1% to 2%, millions of Canadians were experiencing a real after-tax return of approximately negative 6% per year. 6% of real purchasing power, silently removed each year, while the nominal balance climbed slightly, and everything felt fine. This is the silent tax of inflation. And this video covers exactly why growing dividend stocks are one of the most powerful tools available to counter it, why the mechanism works in a way no fixed-rate product can replicate, and what the practical Canadian setup looks like to implement it. Most discussions of inflation treat it as a single, simple concept. Prices go up, money buys less. That is accurate but incomplete. For a Canadian investor, trying to understand whether their savings strategy is actually protecting them, it is worth naming the three specific mechanisms through which inflation erodes wealth. Because each one operates differently and is addressed differently. Mechanism 1. Direct purchasing power erosion. At 2% annual inflation, a basket of goods that costs $100 today costs $102 next year. Over 10 years, that basket costs approximately $122. If your savings have not grown by at least 22% in nominal terms over those 10 years, you have lost real purchasing power, even if the account balance went up. This is the mechanism most people understand, at least conceptually. Mechanism 2. The interest rate tax trap. Interest income in Canada is taxed at your full marginal rate, not the preferential rate applying to capital gains or the eligible dividend rate. For a Canadian earning $70,000, the marginal rate on interest income in Ontario is approximately 29.65%. For someone earning $100,000, approximately 43.41%. This means that for a high-interest savings account paying 3.5%, the after-tax return at $70,000 income is approximately 2.46%, and at $100,000 income, approximately 1.98%. Subtract 2% inflation. Real return of 0.46% at $70,000 income, and approximately negative 0.02% at $100,000 income. The interest rate tax trap is the mechanism that makes the savings account problem specifically worse for higher earners. Mechanism 3. The renewal trap. A GIC locked at 3.5% for 1 year provides 3.5% for that year. When it matures, you renew at whatever rate the market offers, which may be 2.5%, 4%, or 2%, depending on where the Bank of Canada's overnight rate sits. For someone who locked in a 5-year GIC at 4% in 2019 and watched inflation hit 8% in 2022. The inability to adjust to the inflation environment mid-term was a direct trapped real loss. Fixed-rate products protect the nominal rate for the term. They do not protect the real return against unexpected inflation spikes. Why this matters as context for what dividends do differently. A growing dividend does not have a fixed nominal rate. It does not expire and require renewal. And it does not trap you in a rate that becomes inadequate when inflation accelerates. As covered in Segment 2, the dividend growth mechanism addresses all three of these inflation erosion channels simultaneously, which is the specific reason growing dividend stocks are a more complete inflation hedge than any fixed-rate product. Here is the vault, the specific mechanism that makes growing dividend stocks a natural inflation hedge, and why it addresses each of the three erosion channels from Segment 1 in a way no fixed-rate product can. The fundamental mechanism, a savings account or GIC, pays a fixed nominal rate. Its purchasing power erodes at the inflation rate, and the rate cannot adjust upward except at renewal. A quality dividend stock that raises its dividend every year does something structurally different. The income you receive grows in nominal terms, naturally and automatically, tracking or exceeding the inflation rate over time, without any renewal decision, any locked term, or any rate negotiation. The math, made specific with a Canadian example, a Canadian bank stock paying $4 per share annually in dividends today, growing at 7% per year. By year 10, your dividend income from that same share has grown to $7.87, nearly double the original $4. Inflation over the same decade required the $4 to grow to only $4.88 to maintain purchasing power. Your dividend of $7.87 has grown more than twice what inflation demanded, leaving you with meaningfully more real purchasing power per share than when you started, from the same original investment. How this addresses Mechanism 1, direct erosion. The growing dividend income outpaces inflation's erosion of purchasing power. By year 10, the dividend exceeds the inflation-adjusted equivalent by $2.99 per share. A genuine real gain from income growth, not just inflation protection. How this addresses Mechanism 2, the tax trap. Inside a TFSA, dividend income is entirely tax-free. The after-tax return on a 4% yield inside a TFSA is 4%, not 2.46% after a 31% marginal rate, but the full 4%. The tax drag that hobbles fixed-rate savings products simply does not apply. How this addresses Mechanism 3, the renewal trap. A dividend stock does not expire. There is no renewal date. There is no locked term. The growing dividend continues indefinitely as long as the company remains healthy and committed to its dividend policy, without any decision or action required at any fixed interval. When inflation spiked in 2022, Fortis and Enbridge and CN Railway raised their dividends as normal. No renewal required. No trapped rate. The specific businesses that can raise dividends through inflation and why, regulated utilities, pipelines, and railways can raise dividends through inflationary periods specifically because their businesses are structured to pass cost increases forward. A regulated utility's allowed rate of return is periodically reviewed by the regulator. In inflationary environments, operating cost increases are generally recoverable through rate cases. A pipeline charges transportation fees that are often indexed to inflation contractually. A railway prices its shipping in a market with limited competitive alternatives, maintaining pricing power through cost-push inflationary periods. These are not arbitrary dividend increases. They are the output of businesses that earn more money when the costs of everything rise, specifically because they can charge more. The inflation hedge argument for growing dividends is not theoretical. There is a documented historical track record of how specific Canadian companies behaved through the inflationary periods Canada has actually experienced. The 1970s, a decade of sustained elevated inflation, Canadian CPI averaged approximately 7% to 8% annually through much of the 1970s, the most challenging sustained inflationary environment in Canada's modern history. Both Fortis, then Newfoundland Light and Power, and Canadian Utilities were already raising dividends through this period. Regulated utility companies specifically performed well through 1970s inflation because regulators allowed rate increases to recover the higher cost of capital and operating costs, exactly the mechanism described in Segment 2. The 2021 to 2022 inflation spike. Canadian inflation reached 8.1% in June 2022, the highest reading in approximately 40 years. The specific test of whether dividend growth stocks maintained their inflation hedging through this spike. Fortis raised its dividend 5.6% year-over-year increase. Real purchasing power of the dividend was slightly reduced by the 8.1% inflation rate, but meaningfully protected compared to a savings account. Enbridge raised its dividend 3% below the inflation spike, but a meaningful maintenance of the growth trajectory. CN Railway raised its dividend 19% in early 2022, significantly above the inflation rate, driven by strong pricing and volume in a demand-driven inflationary environment. Couche-Tard raised its dividend 26.3% in 2022, its consumer-facing business benefiting from pass-through pricing in a convenience store environment. The results are not uniform across every company in every inflationary period, but the pattern is consistent. Businesses with structural pricing power, regulated infrastructure, dominant networks, consumer essentials have raised dividends through inflationary periods at rates that protect or exceed real purchasing power, while fixed-rate savings products locked in place watched inflation erode their real value. The specific comparison at the 2022 peak. A Canadian who had held $100,000 in a high-interest savings account, earning 2% in 2022, received $2,000 in nominal interest income, taxable at their marginal rate, producing perhaps $1,380 after tax in Ontario at $80,000 income. Real value of that $1,380 after 8.1% inflation, approximately $1,268. Net real gain on $100,000, $1,268, or 1.27% real return. A Canadian who had held $100,000 in a diversified Canadian dividend portfolio generating 3.5% yield inside a TFSA, with dividends growing 5% that year, received approximately $3,500 in tax-free dividend income. Dividend grew by 5%. Real purchasing power of the $3,500 income. $3,500 minus zero tax. Net real gain after 8.1% inflation. Approximately $3,500 minus 8.1% erosion equals still approximately $3,218 in real income value, compared to the $1,268 from the savings account, even with that 2022 inflation spike eroding part of the real value. Every advantage of the growing dividend inflation hedge is maximized inside a TFSA, and every disadvantage of fixed-rate savings products relative to dividends is specifically addressed by the TFSA's tax structure. The full comparison, built on the numbers from previous segments. Scenario A. $100,000 in a HISA at 3.5%, non-registered. Nominal annual income, $3,500. Tax at 31% marginal rate, minus $1,085. After-tax income, $2,415. After 2% inflation erosion, real purchasing power gain approximately $415. Real return, 0.415%. Scenario B, $100,000 in Canadian dividend portfolio at 4% yield, non-registered. Nominal annual income, $4,000. Eligible dividend tax at approximately 8.9% effective rate. After gross-up and credit, Ontario, $80,000 income, minus $356. After-tax income, $3,644. After 2% inflation, real purchasing power gain approximately $1,644. Real return, 1.644%. Scenario C, $100,000 in Canadian dividend portfolio at 4% yield, TFSA. Nominal annual income, $4,000. Tax, $0. After-tax income, $4,000. After 2% inflation, real purchasing power gained $2,000. Real return, 2.000%. Now add the dividend growth layer. At 7% annual dividend growth, the TFSA dividend portfolio's yield on cost is approximately 7.87% in year 10. After zero tax, after 2% inflation, the real return is approximately 5.87% in year 10, compared to the HISA's real return of 0.415% in year 1, that is not growing at all. The gap between a HISA's real return and a TFSA dividend portfolio's growing real return is not marginal. In year 1, it is approximately 1.6 percentage points. In year 10, with dividend growth applied, it is approaching 5 to 6 percentage points. This gap compounds, and the compounding of a gap this wide over 20 years produces the kind of wealth difference that determines whether a Canadian investor has successfully built purchasing power or simply preserved nominal balances while losing real value. The OAS clawback consideration, TFSA income, does not appear on your tax return and does not count toward the income threshold that triggers the OAS clawback in retirement. A retired Canadian drawing $40,000 per year in tax-free TFSA dividend income and $15,000 in CPP has $15,000 of net income, far below the clawback threshold. The same retired Canadian drawing $55,000 from a RRIF has $55,000 of taxable income, moving toward the clawback zone. The TFSA's inflation-beating dividend income is the most tax-efficient and benefit-protecting form of retirement income available in Canada. Understanding why dividend stocks beat inflation through the mechanism in Segment 2 and the evidence in Segment 3 is useful. Knowing which specific characteristics to look for and how to set it up is what makes it actionable. The characteristics to look for in an inflation hedge dividend stock. 1. Pricing power. The company must be able to increase the prices it charges customers at least in line with cost increases. Regulated utilities have this through rate cases. Pipelines have it through indexed contracts. Railways have it through dominant market position. Consumer staple companies with strong brands, convenience stores, pharmacies, have it through everyday pricing. Companies that compete purely on price in commoditized markets generally do not. 2. A multi-year dividend growth track record. At least 5 to 10 consecutive years of uninterrupted dividend increases. Ideally, through at least one significant inflationary or recessionary period. A company that has maintained and grown its dividend through previous economic stress has demonstrated the pricing power and cash flow durability the mechanism requires. 3. A sustainable payout ratio with room to grow. A company paying out 90% to 100% of earnings as dividends has almost no room to grow the dividend further without earnings growth. A company paying out 40% to 70% has meaningful room to grow the dividend, even if earnings growth is modest, which is what you want in an environment where earnings may be pressured by cost inflation. The account setup: TFSA first for all Canadian-eligible dividend stocks. The zero-tax treatment eliminates the interest rate tax trap entirely and removes the HISA's biggest structural advantage over time. Hold quality dividend growers with demonstrated pricing power, sustainable payout ratios, and multi-year growth records. Enable DRIP so that each dividend payment purchases additional inflation hedge shares automatically. Review annually, not to trade, but to confirm the pricing power story and dividend growth trajectory remain intact. The honest acknowledgement: this is not a strategy that eliminates all market risk. In 2022, as inflation spiked, the stock prices of many dividend stocks fell as rising interest rates compressed valuations. A TFSA dividend portfolio in 2022 may have shown a declining account value even as the dividend income continued growing. The inflation hedge in this video is specifically about the income stream, the dividends growing to outpace inflation, not about the share price being immune to market cycles. Investors who need price stability should hold some fixed-rate products alongside the dividend portfolio for that specific purpose. Let's come back to where we started. $100,000 in a savings account earning 3%, taxed at 31%, minus 2% inflation. Real purchasing power gain, $70 per year, less than $2 per week, from $100,000. You now understand not just that this is a problem, but the three specific mechanisms creating it: direct erosion, the interest rate tax trap, and the renewal trap. You understand the specific mechanism by which growing dividend stocks address all three simultaneously, not through vague "stocks beat inflation over time," but through a calculable structural process of nominal income growth that outpaces inflation, in an account that eliminates the tax trap entirely, in stocks that have no renewal date and no locked term. The historical evidence from Canada's own inflationary periods supports the mechanism. The Canadian companies that have raised dividends for 20, 30, and 52 consecutive years, including through the 1970s and the 2021 to 2022 spike, are the same companies with regulated or structurally dominant businesses that can pass cost increases forward. The practical setup is not complicated. Quality dividend growers with pricing power held in a TFSA with DRIP enabled. The $70 per year in real savings account returns is the alternative. The growing dividend income, compounding tax-free, outpacing inflation while the account balance also grows, is what the strategy builds toward. That is not a vague promise. That is a calculable mechanism. And now you have the calculation.